Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a nippy, cold Wednesday morning. It's good weather here in Bombay. The air visibility, I'm not very sure, but I think it's certainly better than our Delhi-eyed viewers who are watching us. Well, not making you guys feel bad, but a little better here in Mumbai this morning. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surbi and Nigel. Guys, hi, morning.
Hi, morning.
Prashant, nippy and cold for someone who spent a considerable time in Delhi.
Brought up in Delhi.
Yeah, nippy and cold. Now the transformation is complete. Here is a Bombay boy speaking. But yes, it is pleasant weather, no doubt, and we'll take it with both hands. Hi, Nigel.
Well, good weather for a Bombay boy.
Yeah, it's cold.
I normally am very cautious about talking about it being nippy because I know both of you have spent a lot of time in North India. But I like it, Prashant. Even I'm feeling a little nippy, cozy. But have to make it to the studio, and we've got markets to look at last few days in this year. So let's get straight to that.
It's the weather when you can sleep in, huh?
Oh, I love it.
That's a tough one, the wake up in the morning.
Absolutely. Well, take it from the top, right, in terms of what you need to know as we begin another session here. It basically got the big story being oil. It's not equities, it's not yields, it's not what Trump said. Maybe it is what Trump said. Maybe in the last, half an hour, 1 hour or so, he's basically put out a Truth post. But the fall in oil is, I think, going to, because it's in the 50s handle now, and 50, so WTI is around 55, below 55 for the first time since February of 2021. Or Brent oil is down 3% last night to about 58, 59. I mean, it's the levels, I think which get you attention, right? You're not suddenly talking about being closer to 70. You're talking about being, in the mid-50s now, and maybe on the WTI below 55. So concerns, of course, around oversupply as we head into 2026. We've heard that from OPEC and their estimates. And, of course, there is, as we've highlighted, right at the beginning of this week, Zelensky dropping demand and ambition to join NATO ever. And I think that's a big deal. So that kind of is clearing up the possibility of at least talks and Russia coming to the table. It's going to be Russia's decision whether to accept terms or not. Because it's in a stronger position right now. This morning, and that's what I said, right? It is some of the big story, of course, is what Trump has said also. Oil prices are up a little bit. They're ticked up 1% on President Trump's orders for a Venezuela blockade. Venezuela, mind you, is a big oil producer, one of the largest oil producers outside of the Middle East, outside of Saudi, etc. And there has been, this military build-up around Venezuela that President Trump has orchestrated over the last, actually it's not very old, over the last 1 month, I would say, right? And I just want to quickly read out what President Trump has put out in his in that post. He says the Venezuela regime has been designated a foreign terrorist organization. Therefore, today, I am ordering a total and complete blockade of all sanctioned oil tankers going into and out of Venezuela. So, that's the crux of it. It's a much longer post, and we can talk about this a bit in detail. But that's another mix, right? As you come closer to figuring out whether Russia, Ukraine pipes down and the war stops eventually, will it be have a calming effect and a significant impact on oil prices on the downside? There's something else which pops up, and this is Venezuela this time around. So more of this later, but that's a developing story. As I said, it's a very large and important oil producer. But the point is we'll have to see exactly how much of oil was reaching global markets, how much of it was basically, because a lot of it was already sanctioned. The actual impact of this blockade, what President Trump has essentially ordered, we'll have to see. So that's oil, right? But in any case, lower oil is great news for a big oil importer like India. Rupee, for example, it's all connected. Oil price, rupee is slid past 91. We've gone from 90 to 91 in about 10 trading sessions. But think about it. Russia-Ukraine sort of conflict settles down. automatically, hopefully, I mean, that 25% penal tariff goes away, and we get access to cheaper oil and without President Trump's ire in that sense. And of course, I mean, it has a calming effect on the rupee as well because of the trade deal and an agreement, etc. So it's all one big linked thing as we look at the next few months or so. U.S. equities closed mixed. S&P down about a quarter. NASDAQ was up a little bit. You had the jobs number which came through. I mean, the November number, jobs added were about 64,000. Expectation was about 50,000. But unemployment rate rose to 4.6%. It's the highest since 2021. Not very much move in terms of macro markets. The 10-year was down about 3 basis points on the yield. 4.15 is where we finally left off. And by the way, the jobs data has not done very much to change market expectations for 2 more Fed rate cuts, that is in 2026. I'll just tie in and look at the levels quickly. So the downside level is, and it's not changed basically, but despite yesterday's very sharp fall on the Nifty Bank, and of course broader markets which fell 1% as well, 25,750 is where the support. It's not a moving average or anything, but it's a cluster of support, 25,750. And 58,850 is that level on the Nifty Bank. So we are closer to it as of yesterday's close than we were day before yesterday. And of course, on the upside, the 20 days have been acting as a bit of a, level, 26,028 as of yesterday's close on the Nifty and 59,299 on the Nifty Bank as well. So that's where we stand with, yesterday's session and looking ahead into this Wednesday's session. 20 points lower on the GIFT Nifty. Nigel is now standing by with what's happened on the F&O side, positioning, etc. Nigel, over to you.
Well, that's a point well noted, Prashant, with regard to the Brent crude prices still hovering at very, very low levels. From an India macro perspective, that's good news. And you'd like to see some stability on the rupee. And one would believe that maybe, in fact, the rupee could peak out, at around this 91.5, 92 odd mark, given that we'll get into a seasonally stronger period in the next quarter itself. Getting back to the equity markets, that in yesterday's trade, the final tick was at the low point of the day, but it was the weekly expiry as well. So the bulls will hope that some part of this is an expiry-related move, and that could reverse. So that's one factor that we'll be tracking. Besides that, a mild positive that I would look at it. Yesterday, yes, the Nifty ended down by close to around 160 points odd. The India VIX still is at very, very low levels. So that's telling you that the fear is still not in with regard to the headline index itself. So we'll keep an eye on that. Nifty cooling off, VIX cooling off, that's normally not such a bad thing. And the Nifty Next 50, that as well ended lower, but that has been a relative outperformer for the last few trading sessions, which is heartening actually because the broader markets have absolutely got pummeled. Moving to the institutional data, well, in yesterday's trade, there was something that happened in terms of the flows that hasn't happened earlier. And it's not happened since the end of October because the FI selling outweighed the DI buying, and the institutions, they turned net sellers for the first time since the 30th of October. This is the FI and the DI data put it together. Moving to the futures data, well, the FIs, they added shorts, both on the index as well as on stock futures. And that's clearly evident on the screen. There is some unwinding of long positions and some shorts that are creeping into the system. The FI short positions now at around 91%. So they're getting to the upper end of the range, normally at around 92% or thereabouts. That's where we've seen them peak out. And at 91% as well, they're aggressively net short on the index itself. You need some good news, whether it's a trade deal, whether it's something on the domestic front. That's what could cause these shorts to get a little bit, a little bit uncomfortable. The PCR has moved down to around 0.9. Remember, it was at around 1.2 odd. So to pull up, the strikes that were fairly active in trade yesterday, 26,000 call, very active, 25,900 call, very active. And on the downside, this 25,900 put as well was active, and the premium was ballpark around 150 rupees, which if you put that in, then you get your levels. Support, 25,750 going by the options data, and resistance, 26,050. That's the near-term resistance. So, that support level has been moving down as the week has been progressing, and that's the important mark. You don't want that to break. In fact, if you pull up the Nifty, the 20 and the 50 DMA, that perfectly tallies in with that range. So on the upside, you have the 20 DMA, which is at around the 26,050, and on the downside, 25,750. The Nifty Bank, well, in yesterday's trading session, it showed some weakness. In fact, it closed below that 20 DMA, which is a bit of a worry. So you'll want it to get back above that because that's where the action is. That's where, the bulls believe that we'll see a bit of a fight back. So the Nifty Bank needs to find its form. Support where it's been bouncing off late, 58,500 on the upside. That's the crucial resistance mark. So let's see whether or not the bulls can fight back because yes, it appears it was more an expiry-related downtick that we did see.
Oh, absolutely. So let's see if the bulls can find their feet today or not. By the way, just a couple of interesting points. Yesterday, after that jobs data came out, the U.S. Labor report, the dollar actually fell, and the dollar is close to a 2-month low now. And the dollar index has come off so significantly. 1 month back, the dollar index was at 100. Yesterday, after the data, it fell to 98.20. This morning, it's recovered a little bit. But this at a time when, the Indian rupee has been doing its own thing, absolutely paying no attention to the overall dollar weakness and sliding even more. So that's something that we are going to keep an eye out on. And by the way, after the jobs report yesterday, there was some buying in gold because all said and done, October, there was a fair amount of job loss. The November numbers were better than expected, but it seems that, there is a debate out there. So yesterday, gold rose a bit. This morning, silver, pull-up silver is up 3.5% this morning. So that excitement in the precious metal space, that continues. There we go. Look at international silver prices, 65.53 on the screen now. Quite a move over there. Asian markets are fairly mixed. Let's pull up the ones that we have for you and then the implied open. Again, not too much of clarity after the jobs report yesterday. So you got some of them like the Nikkei, the Hong Kong market, mainland Chinese markets are flashing a little bit of green. Does that mean that we'll bounce back? Let's see where the gift open is, where the gift nifty is and where the implied open is. After yesterday's drubbing, will we continue to be in that range? Right now, it's anyone's guess, about 18 points lower. All right, let's welcome our first guest on the show, Conrad Saldana, Managing Director and Portfolio Manager at Neuberger Bergman is with us. Conrad, thanks so much for being with us. Season's greetings to you. Hope you're getting all set for a fantastic Christmas break. But before that, I want to start with how you're viewing this decline in the Indian currency. Because apart from taking your call on asset allocation over here, the kind of stocks you want to own, currency seems to be a big factor, down 7% this year. How are you thinking about it?
Thanks, Surabhi, and season's greeting to you as well. It is a little surprising, given that the dollar has been relatively weak. Now, I'd say the conundrum also is not just the rupee, it's also been the Japanese yen. But for the rupee, given the export data that's coming out, is proving to be more resilient to the US. I think it's probably the fund flow argument that's pressuring it a little bit, given the FI outflows continue. I think it was a couple of $100 million. But it should see some stabilization here, but it seems to be in a bit of a free fall and defying most other currencies as well. So it was a bit of a conundrum, especially if you're looking at returns in dollar terms for foreign investors. It has been a big underperformer.
Yeah, which was my question, Conrad, that whether going forward, as you take your allocation calls to India, whether you'll be a little more hesitant, if at all, looking at the way the currency is behaving, and whether that's the kind of conversation that you hear around. Till now, allocating to India is, the deciding factors are earnings growth, AI or no AI trade, etc. But now, will currency become another impediment?
Yeah, that's always a factor for a hard currency investor from whether it's the US or Europe, right? And I think it will come back to, again, I think it's sentiment, right? And it's been so negative. What are the other choices? And so in a relative context, if the AI machine keeps on working, giving you earnings growth, when that fades, my guess is India would be the alternative investment, right? In a sense, much more domestic oriented, but you need to see that growth come through as well. So I'm less negative about that. But the alternatives has been when India was doing so well, it was China that was seeing the brunt of the outflows and a lack of investment. Now you've seen that turn around where China, Korea, in fact, this year has been star performers. So those have seen tons of inflows coming through, but you've seen that in share price performance, but also in the earnings growth coming through. So I think the setup for India looks a little better into next year, but we'll have to see in terms of does real growth come in softer, but potentially inflation with the depreciation of a rupee, does the inflation factor creep up? So maybe nominal GDP growth actually turns out fine, right? But the mix of that might be slightly different, and hopefully that transmits into better earnings per share.
Okay, all right. Good to get that perspective, Conrad. Morning, Prashant here. So as you look into 26 from a portfolio perspective, are you sort of happy to hold what you own and we've discussed some of the names in the past. Would you be looking to make any changes? Any parts looking more attractive? Others looking a little more challenging? Has the setup changed at all from a portfolio perspective?
I would say the setup the hasn't changed significantly, but I think the biggest change you've seen in the last 3 months has been a bit of a destruction in the small and mid cap space, right? And with that liquidity coming out, you saw an acceleration into the outflows. But so I do think that they're starting to look more attractive. And there are not many takers right now. I think most strategy here would be, listen, if foreigners want to come in, the first port of call is to come into the larger cap names. I think on infrastructure, you got L&T looking good. I think the bigger banks are fine. The credit quality is not deteriorating. Potentially rate cuts, while could be happening in the West, especially in places like the US. In India, I think it's not a foregone conclusion given how much the rupee has slipped. So I would say that that's another good area with the larger banks still executing. So I'm constructive on that. But I do think the dark horse really is the small and mid cap space that was once the fancy of most funds. And has really gotten hit pretty hard and is starting to look attractive fundamentally. I'm not sure what turns it around apart from them posting good numbers and the market coming back, but that would be a second derivative as the fund flows start to come back.
All right, Conrad, name a few stocks, right? In the past, we've spoken about, I think, HDFC Bank, SBI, Axis Bank. Those are stocks that you like in NetWeb as well as Orient Pro. Anything new that, that y'all have added? And also, I think y'all had a view on EMS, if I'm not mistaken, some time back. The EMS space, though, it has a big potential. Some of the stocks have come off. Did y'all get in?
The ones, and Nigel, I think when you look at the EMS space, some of the smaller names have really gotten impacted. I would say, to me, the bellwether has and will be Dixon's. This is a name, just met with management recently in New York. They're executing. Yes, when you look at the end markets on the consumer space, it's a little bit softer, and they are more geared to mobile phones. But it's still a market share gain for them. So I think that goes unabated, and then they continue to expand their verticals. So I do feel that, listen, one name that's a bellwether longer term, that thematic has not changed in terms of more production in India and using it as an export engine just to diversify away from a risk standpoint for most companies globally. That has not changed in my mind, irrespective of the tariffs jurisdictions. And I think part of the problem is that these tariffs haven't gone away, right? From the U.S. standpoint, but for the exceptions that you have in phones, etc., I do think that there's an offering for India here. Dixon's is one that I think comes out as among the listed space as having the best runway and the best execution.
Okay, all right. We'll leave it there, Conrad. Great conversation and very useful to get that perspective. In case we don't speak again, wishing you, your team, your family a very happy new year, and see you in the new one.
Same to you, Prashant and Nigel and Survi. Thank you. Cheers.
Thank you very much. Okay, well, I'll just quickly run you through the interactions you'll hear on the program on the channel over the next 2.5 hours. So, Deven Choksi at 8:30 will be talking stocks, individual names from yesterday, follow through, and of course, new ones. 9 o'clock, Ajay Parekh of Soham Asset Managers talks to us about Vedanta, that green light from NCLT for demerger. 9:20, Mahesh Patil, CIO with Aditya Birla Sun Life AMC, is a market master of the day. 9:35, Patanjali Foods will be with us, and we talk about outlook for 2026. FY27. And we have the top team from the Bank of America equity team to talk about the 2026 outlook. We'll cover strategy, hospitals, pharma, and autos. And a little later, we've got a macro discussion lined up with Jahangir Aziz at 10:15. It's the economy. Lata will carry the conversation forward.
Time to slip in a short break. Got a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Shriram Finance, Indian Overseas Bank, Glenmark Pharma, Lupin, TCS, Keynes, eClerx, as well as Ahluwalia Contracts. All of them will be reacting to positive news flow. On the flip side, AkzoNobel as well as Ola Electric will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. So the cues across Asia are mixed, but there is some green. Now, that's not entirely translating into, a very buoyant-looking gift nifty. And there's still some caution out there. If you're looking at the implied open, it's suggesting that it'll probably start 15, 20 points lower. By the way, the whole financial space is going to be in focus because of the deal that's happened in the unlisted financial space here in India. And that is the Japanese giant Mizuho coming in to buy a majority stake in Avendus, which is obviously an investment bank here. They're putting $500 million to work. So we'll talk about this. We'll talk about the financial space. In fact, that brings me to our list of stocks that we should focus on. And we have our team standing by with all the key movers and shakers of the day. Guys, morning to all of you. Oh, OK. I think Gaurav is hitting it off. And since I was just referring to financials, Shriram Finance is going to be in focus. Their board meeting on raising capital is finally happening, I think. Gaurav, tell us more.
Well, as Shriram Finance is in focus, and the reason being that 19 December is a date where board meeting will happen, where company will consider fundraising, which also includes QIP. Now, why this is important is that, as you mentioned about the Japanese players, it seems that Japanese players are already and actually very interested in the Indian financials, because we have seen some deals happening, and there are some reports which suggest that MUFG Group, which is a Japanese group, is interested in buying 20% stake in Shriram Finance for a valuation of around $3.2 billion, which roughly translates to around 29,000 crores. Now, if you look at Shriram Finance, it does not need capital right now. The CET ratio is well about 20%. But if you look at why this is important for Shriram Finance, is that it will bring fresh capital to the company. It will bring down the cost of funds, and at the same time, given that there will be some big name coming up in the company, there is a case of credit re-rating which will further reduce the cost of funds. Now, if you look at the stock performance in the last 6 months, we have already seen Shriram Finance giving stock returns more than 27%. And even if we look at the valuation, currently it stands at 2.2 times price to book on FY27. If you compare it with the closest peers, which is Chola Finance, it stands at around 4.1. So definitely there is also further headroom for growth in terms of valuation as well. Specifically, if you look at management, earlier they had denied categorically, but during the conversation with us, management said that there will always be many discussions going on and there will be some interested parties. So that was something which we took as a hint. Apart from that, IOB is something which will be in focus because government is going to sell around 2% stake in the company. Now remember, government holds more than 94% in the bank, so they are going to go with OFS to reduce the stake further. And remember, there is also a requirement of minimum MPS, which is around 75% of the stake, where government has to bring it down to 75%. And given that IOB currently stands at around 94%, where government hold 94%, it is important for government to bring it down. This OFS, it's coming at around 34 rupees per share, which is 7% discount to the current market price. But let's not forget that the price to book is at around 2 times for the bank. So definitely this bank is also going to be in focus today for trade.
Gaurav, thanks very much for that list. Appreciate it. Well, let's talk about pharma now. Ekta is here with news on Glenmark and Lupin. Ekta, morning.
Morning. Well, I'll start with Glenmark Pharma. It is in focus because it's entered an exclusive licensing and distribution agreement with Hansoh Pharma, which is basically for treatment of a non-small cell lung cancer drug, basically a drug for lung cancer. And Glenmark will be receiving exclusive rights to develop and commercialize it in licensed territories such as Southeast and South Asia, Middle East and Africa, Australia, New Zealand, Russia, CIS, etc. Now, Hansoh is going to receive an upfront payment of low double digits, a million in USD, milestone payments which could possibly accumulate to over around $1 billion, and tiered royalties on net sales in the licensed territories. So Glenmark has said that the reason for them to do this is basically to build and to strengthen their oncology portfolio and near-term commercial pipeline. However, there is an outgo of money which Glenmark will be putting in. So the street will really be waiting to see how the potential of this drug is going to pan out. Now, Lupin is going to be in focus because their Nagpur facility, which was inspected in September, received 6 observations, is now cleared. It's received an establishment inspection report with a VAI, which is basically a voluntary action indicated status. So that stock should be in the green.
All right, thanks a lot for that, Ekta. Well, let's hop across to Hormuz. Hormuz, a couple of interesting large trades is what we're looking forward to today. That's on AkzoNobel. And Ola Electric. promoter cashing out. Tell us more.
Morning, Nigel. And yes, you start off with Ola Electric. That was the bigger announcement last evening. And they informed that Bhavish Aggarwal, the promoter, sold around 0.6% stake. It was a 92 crore block deal that he sold. And the company later put out a statement saying that the stake sale was done to ensure that the promoter loan of close to 260 crore was repaid, and thereby removing the overhang of pledged promoter shares in the company. Of course, it remains to be seen that the 260 crore loan repayment involved only a 92 crore block deal. The other one being the fact that Bhavish Aggarwal still has a 30% stake in Ola Electric as of September of 2025. The stock, of course, trading at record lows. The IPO price of 76 rupees, so down 54% from those levels, and a post-listing high of 157, and it's down almost 80% from those levels. So, of course, going with red for Ola Electric. And the other one, of course, is AkzoNobel. There's a block deal where the promoter entity is going to sell up to 9% stake. That block deal valued at around 1,300 crores. The floor price is a 13% discount to yesterday's closing price. The promoter entity, which is Imperial Chemical Industries, had a 45% stake in the company as of the September quarter. So keep an eye out on this. It'll be interesting to see who are the buyers that emerge in the deal. But still, initially going with red for AkzoNobel as well.
Okay, all right, got that. Lots of buying and sellings in those deals. Make for interesting news for sure. So both Ola and we'll watch out for the other one as well. On to Upasna. Then Upasna, you're watching out for a bunch of names. Tell us which ones are they?
Well, certainly. Good morning. First up, let me start with TCS. Now, according to a Mint report that the company has bagged a mega deal valued more than $1 billion revenues from Telefonica, UK-based company. Now, when we reached out to the company has responded stating that it's a purely speculative report and company has not commented on the same. Next up is Keynes Tech. The Keynes wholly owned subsidiary, that is Keynes Semicon, announces strategic partnership with AOI Electronics and Mitsui. Both are Japan-based companies, and the key rationale behind this is to strengthen its upcoming semiconductor manufacturing operations in India. Now, company says that these alliances are expected to play a crucial role in advancing company's ambitious target in terms of semiconductor and even India's global semiconductor hub target mentioned by the PM. Now, Eclairic Services also in focus. Now, buyback price has been increased from 4,500 to 4,800 per share. Consequently, the maximum number of equity shares proposed to be bought back will be reduced from 6.6 lakhs to 6.25 lakhs. And lastly, we are looking at Ahluwalia Contracts as well, as the company backs order worth 888 crore from Bihar State Tourism Development Corporation, and the execution timeline is nearly about 42 months. So all in all, we'll be watching out for all these stocks in today's trading session.
Okay, all right, all of them on our radar. Thank you very much for that, Upasna. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them would be Shriram Finance, Glenmark Pharma, Lupin, TCS, Keynes, eClerk Services, and Ahluwalia Contracts. Stocks with negative news flow, largely on the back of share sales that are likely to happen in the market, would be IOB, AkzoNobel, and Ola Electric. Okay, so that's our stock list for the morning. Now let's find out what's happening in the world of commodities. And we have Manisha joining in with the latest. Manisha, I didn't notice anything else, but one thing is that oil is falling and silver is rising. There's no stopping the silver rally. What's the latest?
Well, that's exactly the headlines today coming in from commodities. You have silver, which has now gained 3.5% in the overnight market. And even as a lot of people are now getting cautious because you've seen a 127% of gain come in for silver. I mean, it's not like a small cap or something. It is a precious metal. It's a globally traded commodity. And the way it has been surging, markets do believe that the momentum perhaps could still be on the higher side. We already are trading above $65 an ounce, and markets do believe that by the time we close this year, it could perhaps be well within 65, 68. We would have achieved those kind of levels there. But yes, there is a very sharp profit taking in the meanwhile come in for the crude oil prices. 3% of a decline in the overnight markets. It's trading at the lowest since 2021 right now. This is the third straight year of decline in crude prices, and we are down by 23% in this year. It has been about surplus that is coming in from OPEC Plus, which is reviving its idle production. And the non-OPEC production also continues to be on the stronger side. And meanwhile, you have weaker demand trends coming in from China, Middle East, and US, and that continues to weigh onto the markets. But the street will watch out for many central bank meetings that are expected this week. You have Japan, England, European Central Bank. So further cues for many of these commodities will come in from here.
Okay, all right. Manisha, thank you very much for the latest. We'll take a break on that note, come up on the other side. And we'll have Deven Choksi joining in. We'll discuss some of these stock ideas and some of the stocks in news with Deven in just a moment.
Welcome back. There's 25 minutes to go for the pre-open session. The Lok Sabha approved the Insurance Amendment Bill, something we've reported on extensively. This bill allows, the amendment basically allows foreign companies to own up to 100% of Indian insurance businesses. The government believes this will bring more money into the sector and make it stronger. The bill also introduces changes to improve how insurance companies are run and to increase coverage across the country. You know, let's listen into what the Finance Minister had to say first, then we'll get you industry reactions.
Percentage of FDI and the number of insurance companies. In 10 of them, less than 26% FDI is there. I said total of 74. In 10 of them, less than 26%. In 23 of them, between 26 to 49%. In 3 of them, 49 to 74%. And at 74%, there are 4 of them who have FDI at 74%. Sir, there is need for growing protection through insurance in this country. We need to have insurance more accessible. Enhancing FDI limit through Section 3AA of the bill to 100% will enable global insurance to inject substantial capital directly without waiting for domestic partner to invest capital in parallel. We're also empowering the regulator. This is very important because many members thought we are empowering the regulator. It's so empowered. It is empowered for a very good thing. That is disgorging wrongful gains. When most of the time wrongful gains happen and somebody's gained it, you don't have the statutory power to disgorge that and give it to whoever have been made to suffer. Now this one will give that power to the regulator to disgorge wrongful gains from insurers and from intermediaries.
All right, so that was the Finance Minister outlining some of the key features that this bill addresses and the reform, the intent behind it. We spoke with a whole panel of experts, former practitioners and current practitioners from the insurance sector. They all weighed in on what this bill finally means for the insurance space. Listen into the views.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at, but looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get, early investment, and not just do they gain, but even we gain at the same time.
When it comes to distribution network to be broadened, the IRDA already permits that. Almost about eight such banking institutions they can tie up with. So this will be really maintained. So the other piece is the merger of the non-insurance with the insurance. There also, I believe, the regulation can come in where they can probably lay down that, if at all any such thing happens, what are the precautions which needs to be taken, and how they will ensure that the liabilities of the non-insurers should not really get into the insurance companies. There can be a firewalls which can be created to really address this concern also.
Okay, there you have it. Big wigs from the insurance sector weighing in on what this big reform really means for them and the overall insurance industry. Let's get in Deven. Of course, we have plenty of questions for him today. So, Deven, it's going to be a rapid fire because we have a lot of ground to cover. Let's start with insurance. What have you made of the bill? 100% FDI. Maybe the foreigners come in. Does that increase competition? Is it good? Is it bad? But for the timing, at least no open architecture. How do you sum it up? And, give us 2 or 3 insurance stocks, your take on them, avoid, sell, buy, anything.
Yes, Urbi. Good morning. Well, I think the most of the coverage, as far as the insurance is concerned, largely, I think what we are seeing is basically, a possibility for some of these insurance companies in the area of launching of new products. The foreign insurance companies coming into the country, I think they are going to create their own segmentation. Some of the large underwritings, I think, would go to the big network foreign insurance companies, whereas some of the micro insurances, the smaller ticket insurances, would go to some of the Indian companies, be it, I think, the likes of Bajaj, be it likes of Jio. I think they are the likes of those companies who are likely to take the advantage of the micro insurance business, I think, which is going to get opened up for themselves. The larger insurances, I think, are being underwritten by some of the larger foreign companies, and they would have an entry into the country. Whether they would have an entry into the country through some kind of alliance, answer should be yes. I think they should be having ability to invest 100%, but at the same time, I think they would require the Indian partner to definitely, I think, work along with them. So overall, I think we believe that it's a structurally positive move for the sector as a whole. Which companies we feel are the most beneficiary? I believe that the companies with a balanced portfolio of products, likes of HDFC Life, likes of SBI Life, I think they may remain, relatively more stronger, at least to begin with. But I think the potential-wise, if you look at, the Bajaj could possibly be a surprise winner in this entire game. So let's wait and see, because they have a good footprint, including, the Jio, they have good footprint. How they evolve into newer products, I think, remains to be seen. But we remain distinctly positive about the possibilities of some of these companies.
Okay. All right, Devin, got that. A couple of other stocks. Shriram Finance. Board meeting comes up tomorrow. There's so much of speculation about whether they are going to get in a Japanese investor now. Your thoughts?
Not honestly evaluated, will be, at least I think this particular possibility is concerned. So would probably wait for the event to unfold and then evaluate.
But do you have a positive view otherwise? At current prices, does it still make sense to buy?
Well, I think overall the entire fabric looks pretty set for the NBFC company as a whole. Not completely, I think, glued on to the Shriram Finance, because I think the larger amount of focus stays with the likes of Bajaj Finance in our portfolio. So we probably remain more comfortable over there vis-a-vis others at this point of time.
All right, Deven, and lots more questions for you. For the time being, though, we slip into a short break. We request Deven to continue to stay with us. We'll get our technical experts as well, who'll join us on the other side. Welcome back. Hope you're having a good morning. Well, let's hop across to Hormuz. As always, he joins us to take us through the big movers yesterday, which were backed by delivery. Hormuz, morning.
Good morning, Nigel. And EPAC Durables is the first name on the list today. And along with those consumer durable names that were beaten out of shape, EPAC Durables was no different. But yesterday, the stock was up 15-16% with the biggest single day gain and volumes since its listing. And the stock also fell to a 52-week low last week, and it has rebounded from those levels. 3.5 crore shares were traded yesterday, the 20-day average of just over 7 lakh shares. And out of those 3.5 crore shares, 25 lakh shares were marked for delivery, the 20-day average of just around 3 lakh shares. The stock, despite this move, is still down well over 50% from its 2025 peak, which is close to 670 rupees. Exicom Telesystems is another stock that moved higher. The stock was up in double digits at one point of time, ended with gains of close to 8%. The fourth straight day of gains for the stock. Volumes were the highest since May of last year, and the stock has gained in 5 out of the last 6 sessions, close to 1.5 crore shares traded yesterday, the 20-day average of just under 5 lakh shares. But again, out of those 1.5 crore, only 8.5 lakh shares were marked for delivery compared to a 20-day average of just under 2 lakh shares. The stock, despite that move yesterday, is trading below its IPO price of 142 rupees, and it is one of those IPOs that was subscribed over 100 times. Very strong investor interest. The stock had made a peak of well over 500 rupees last year, and it's down well over 70% from those levels. And lastly, Nazara Technologies was a name that sprung up among the list of gainers yesterday. The stock has gained in 5 out of the 6 sessions as well. Tuesday's volumes the highest in over a month. Over 50 lakh shares were traded, which is 5x of its 20-day average. And out of those 50 lakh shares, 12.5 lakh shares were marked for delivery, 20-day average of around 6.5 lakh shares. And the stock too has been an underperformer in the last 6 months, seeing losses of close to 30%.
Okay, all right, Hormuz, but we can't let you go at that. Tell us, what about the brokerage calls of the day?
A couple of initiations that have come in, Nigel, on the brokerage front, but we start off with the bigger one, that is Morgan Stanley's note on Reliance Industries, where they have maintained their overweight recommendation, but they have increased their price target to 1847 from 1701 earlier, and this is the second highest target on the street now for Reliance Industries. They are expecting 20% potential upside, yes, but Morgan Stanley is expecting a re-rating and an earnings upgrade every quarter in 2026, and they are saying that this $80 billion worth of investment that Reliance Industries has made since the start of COVID-19 will start to pay off in 2026 across verticals, and that is what is driving their bullish stance. The second one is an initiation on Meesho. We were speaking about this yesterday, the stock being up almost 70% from its issue price. UBS has initiated coverage here with a buy rating, a target of 220. So another 22% upside from the stock that has already surged from its issue price. Now they're saying that the asset light and negative working capital business model has ensured that the company has positive cash flows already as compared to a lot of the other internet related businesses. They're expecting the company's net merchandise value to grow at a 30% CAGR over FY25 to 30, and that will be led by a growth in the annual transacting users that will grow from just under 200 million to well over 500 million between FY25 to 30. Now the other initiation has come in on Orkla India. Contrary to Meesho, this stock is trading below its IPO price. JP Morgan has initiated here with an overweight rating, a target of 745, upside of around 21-22% here as well. They're saying that the earnings growth will gather momentum from the second half of the year. That will be led by revenue growth, margins expansion, and that was one of the factors why the stock has underperformed so far. Their valuations are also inexpensive compared to peers, and they are expecting their revenue and EPS CAGR of 9% and 13% respectively over FY26 to 28. The slower than expected revenue ramp up, volatile raw material prices, and any earnings dilutive M&A activity are some key risk factors for Orkla India, as what JP Morgan has highlighted.
All right, thanks a lot, Hormuz, for joining in and giving us all of those details. Well, let's go back to Deven Chokshi. Deven, I wanted to ask you about Ola. You know, people got very, very excited about the prospects. The company seemed to be on the cusp of a turnaround. I recall when the stock listed went to 140 rupees. Then it saw a sharp downtick, and then it doubled to nearly around 75 rupees. But yesterday, the big news is the promoter, Mr. Bhavesh, has come and sold some shares in the open market. They're justifying it that there was some leverage, there were some pledged shares which now get released. But what's your view at around 34 rupees?
Well, Nigel, I think obviously few things are clear. We don't see a differentiator in this particular company's business. And that's where I think we are a little bit circumspect. We have been, I think, from the very beginning. And today, I think it is getting more and more confirmed that peers, I think the likes of Bajaj, the TVS, who are actually, I think, penetrating big time into the market through the distribution reach as well as, I think, the product superiority, as I would call it as. They're relatively better off compared to the Ola Electric in particular. So, in my viewpoint, I think this is going to be a little bit more challenging kind of an environment for them unless they create a very significant amount of differentiator for themselves in the product segment. I don't see too much of clarity at this point of time for the company.
No, I got that. Devin, just a quick word, and I'm sure, Nigel, you'll talk about Vedanta, right, in a bit from now. There is an upgrade which was flashing at the bottom of the screen as well. But that is the other news which came out, and stock ending pretty much at the day's highest point, that NCLT merger finally going through. Just your view on it from a stock point of view. And yesterday we had, Rakesh Arora, who's the veteran metals analyst who was with us and who kind of he had a slightly non-consensus view. The consensus is that it's great news. His view was slightly more downbeat, that maybe, and for a bunch of things. Where do you stand in this one, Vedanta, Devin?
Yes, Prashant. I feel that I think leave the Hindustan Zinc aside because it is already a listed company. It is not part of the demerger at this point of time. But overall portfolio of, I think, all the metals that they have, including oil and gas, I think the demerger is a good news because I think if you notice for last 8 quarters or 12 quarters, I think there have been a significant amount of constraint for the company to expand into different product categories, largely because of the fact that I think the balance sheet size was not permitting, at the same time the leverage position was bothering. Now, with this demerger taking place, they have a reasonably good chance of, I think, inviting the higher capital at the same time deleverage themselves in a systematic manner. And given the kind of metal commodity cycle, particularly for the white metals and also the copper, I believe that I think the company is ready for taking the larger amount of benefit in coming period. So yes, I think there may not be many short-term triggers, I agree, but at the same time, I think the potential looks, I think, quite brilliant from the 3 to 5 year perspective, because we structurally believe that the white metal and the copper as a commodity, I think are likely to show better performance in coming 3 to 5 years.
Devin, always a pleasure having you on the show. Thanks a lot for joining in and giving us those details. Have a good day ahead, Devin. Well, on that note, we'll slip in a short break, come back. Priyapan Rich will be with us. And as promised, technical experts as well will be joining in. We'll also get a view coming in from Sanjay Parekh of Soham Asset Managers on the NCLT approving Vedanta's demerger finally. Stay tuned.
Okay, well, I think we are hitting market open. The pre-open for stocks, of course, I think we can ignore for a bit because it tends to go all over the place and settle. But I think we can look at the rupee. I think the first rates as they start to come up, the dollar rupee rate, nothing yet. It's, I think, maybe a couple of more seconds and we should have it right about now. We'll put it at the bottom of the screen with regards to how it's opening. Sudarshan Sukhani is with us. Shrikant Chauhan is with us as well with technical trading ideas. Gentlemen, good morning. Good to have both of you here. Apologies coming to you later than usual. Sudarshan, you go first. Yesterday was a bit of a slide, slam dunk in that sense. Broader market sold off 1%, Nifty, Bank Nifty a little lesser. How do things stand and how do you look at indices first, Sudarshan?
Yeah, good morning. Yesterday, the suggestion was to go short below 25,900, but today it's different. The Nifty slide brings it to a very strong support zone between 25,700 and 25,800, that 100-point zone. So that could act as support, or if it breaks, it should probably lead to a significant decline. But when we are closing close to that support zone, a short selling idea is not justified. We have to wait and find out if the Nifty will hold that support, then maybe again begin and try to test higher levels. So at this point, there is really no trade in the Nifty. Wait and watch for a day or 2 days. what that support zone does.
Okay, all right, got that, Sudarshan. Shrikant, let me come to you. Indices, do you have a trade?
Good morning, Survi. Good morning, Nigel and Prashant. So yes, for Nifty, it has been consolidating within the range of 26,200 and 25,700 on the downside. 25,700 is certainly going to act as major support for the market, and ideal strategy should be to look for taking long bet close to 25,750 sort of levels, or maybe between 25,800 and 750 with a stop loss at 25,650. So till the markets are not closing convincingly below the levels of 25,700, we are of the view that market should remain in a range and again can bounce back to the levels of 26,050 or 26,100 sort of levels. Most of the stocks have fallen to their important support levels. But if we consider the breadth of last 10 days, then we have seen some unique sort of activity. We saw some increase in the overall breadth of the market. And based on that, I'm of the view that 25,700 should act as major support for the market. And there we should look for taking some long bets.
Okay.
Okay, all right. Let's get to the picks then, gentlemen. Shrikant, you go first.
Yeah, so we are relatively bullish on mid-size bank. There we are seeing consistent buying interest in stocks like Ujjivan Small Finance Bank or IDFC First, Equita Small Finance Bank. So there we are seeing good amount of price action. And yesterday we saw some consolidation in IDFC First Bank. Currently it is around 83.50, 84 sort of levels. But based on its technical formation, I am of the view that stock is gradually moving towards the levels of 88 and 91. So here we should look for creating some long bet with a stop loss at 81.50 for short-term traders. And for positional traders, the target is close to 91, 91.50. The other stock on which we are bullish is from the metal basket, and that is Nalco. It is forming rising top, rising bottom series, and it is now very close to its important resistance level based on extensions. On the dismissal of that 280, we can expect rally towards 300 sort of levels. So currently at these levels, it is like showing some signs of consolidation. But at this level, if we buy, we can keep a stop loss at 270 for the target of 300.
Okay, all right. And in fact, on Nalco, as Vedanta and Hindalco had put out a piece, I think 10 days or so ago, that aluminium looks pretty well placed for the next couple of years, going by the global dynamics. So Darshan, coming across to you, what's your view in terms of individual stocks?
Well, it's a mix, 2 buys and 2 sells. Bharat Forge is a buying opportunity, buy with a stop under 1380. Balkrishna Industries is the second buy with a stop under 2325. The intraday shorts are Cyient, CYIENT, with a stop above 1165, and TVS Motors is an intraday short with a stop above 3680.
Okay, all right. Thanks a lot, gentlemen. We'll keep coming back to you all to get your calls as the course of the day does progress. But now let's focus on Vedanta, which was the big stock after they got that green signal coming in from the NCLT with regard to the demerger. Kotak, they have come ahead. They have put out a note on Vedanta. They've upgraded the stock with a target price of 650 rupees. They revised the consolidated EBITDA by around 4 to around 6% because they are factoring in higher LME prices and weaker Indian rupee as well. Now, it's important to note that the commodity price assumptions that they're making are 5 to 25% below what spot is at. They're saying going by spot, the FY28 EBITDA would be 10% higher. And that pegs the bull case, stock price or target price at around 770 rupees, but that's based on FY28 financials. A few factors that they're highlighting: buoyant commodity prices puts Vedanta in a sweet spot. The aluminium division is in a sweet spot, both on growth as well as on margin accretion. And they're estimating the aluminium, profitability or the margin will move to more than $1,070 to around $1,100 to around $1,200 from around the $940 that it last hit. So aluminium could be the big driver. And finally, the parent, that's Vedanta Resources' debt concerns are well behind. So put all that together, Kotak upgrades the stock and they're quite positive. But let's get in someone who's been quite positive on Vedanta for a while now. We have Sanjay Parekh, founder and chief investment officer at Soham Asset Managers, who joins in. Hi, Sanjay. Appreciate you joining in. We just want to talk about this particular stock in this conversation because you have been bullish. I recall for the last 18 months or so, we have been asking you, and sometimes not at the great times, but you have said that Vedanta is a stock that you'll like and you'll have in your portfolio. Now, a couple of quick questions. Could you tell us, they say that, there'll be some unlocking of value. Could you put a number to it? Currently the stock trades at around 5.5 times. if once the divisions are separated, where does this value unlock come in?
Yeah, so good morning, Nigel. As you said, we own the stock, so we clearly have interest in our clients' portfolio in REI as well. So with that, disclosure, clearly, the positives are each of the entities will be a bit focused. The multiples you rightly covered is, today 5.5 times, but aluminum, when it becomes a focus entity, there's a very clear scope to go, up to 6.5 to 7 times. The power assets, which will be total 5,000 megawatts, that today is valued at EV of 2.5 crore per megawatt. That also there is scope for re-rating. And HZL implied in the price of Vedanta, right? HZL, based on EBITDA at 10, it's at 10 times EV EBITDA. But when you imply the Vedanta, it's less than 7.5. So there as well, which will remain the standalone entity, there could be a leg up. So the sum of part, we believe very clearly there is a possibility of value upgrade. Our value before this announcement of demerger was on 28 at 670 to 680 rupees. So with this demerger, for sure, at least 10 to 13-14% upside is due to just because of the demerger.
Okay, got that. But there's a corporate guarantee as well that they have to give. How do you view this? It was on expected lines. I've had a chat with the management, and here on CNBC-TV18 itself, we've asked them. They said they're comfortable giving that corporate guarantee because of the ongoing litigation that's there. Do you believe that's a bit of an overhang, or do you believe that will be put in one of the entities and that's par for the course?
Yeah, if you, all these PSC contracts, typically, you have to at times, give a disclosure in terms of cost for the capex, and there are several items which are at times contested. So PNG RB rightly, was not comfortable with the energy entity ability to, in case there are liabilities to provide for the energy. So the standalone entity has given a guarantee. I think it's around 16,500 crores, but I don't know whether how much of this could crystallize because a part of normal any PSC contracts in the profit sharing contracts, there could be such items which are contestable. So, we don't know exactly how much of this is crystallized, but if there is a small amount it crystallizes, maybe 10-20 rupees per share, the standalone will have to take that by, fulfilling the corporate gain.
Okay, all right. So you don't believe that's a big overhang? I think majority of the street, at least as per what details we have as of now, you don't believe it's a big overhang, and some are hoping that actually goes in Vedanta's favor. So we'll have to wait by for that. Sanjay, I'm going to be speaking to the management hopefully in the next 24 hours or so. Mr. Anil Agarwal, hopefully we do get him, and we'll get him exclusively on CNBC TV18. What would be that one thing you'll be looking forward to when we speak to the management? Because it's always been a little bit tricky with regard to what the promoter is going to do next. And over the last 15 years, we have seen him do a lot of things. But now it seems that he's headed in the direction of value creation. What's that one question you want me to ask him?
First is complimenting the man. I think they've paid 90,000 crore dividends. They have done, it was very, very tough, right? The journey was tough, and yet they moved into demerger. So that's the first compliment you would give them. I mean, their clear eye on market cap creation is there. Only always the worry the street has is like these like JP, which are not within the core area, or any big expansion which will come in standalone, is one thing which is not related, which will worry the market, That is one area where they need to give more comfort. The rest is all absolutely, we have to give kudos to the team.
Don't get over adventurous. I think that's the message. And, I recall in the last many months, I've been asking the management, how keen are you all on JP? But I think from a shareholder's perspective, as you're saying is, you're happy that at least that hasn't gone through and, it'll be an unrelated part of the business. Well, Sanjay, congratulations first on that call on the stock. You have been holding your ground. We have seen the stock, fall multiple times in the last few months, but you have held on to that. So congratulations, and hopefully we do get the management later.
Absolutely, and I think we'll ask Mr. Agarwal some of the questions which, Sanjay, you want us to ask. Well, I think 9-10 calls. I think we've got 4 minutes to go for the market open to kick off. So, Darshan, what do you have?
Balkrishna Industries, buy with a stop under 23.25.
Okay, all right. Balakrishna Industries is the stock on Sudarshan's radar up on your screen now. Well, brokerage call of the day, Gaurav is here with that call on financials. Gaurav, it was financials yesterday as well. I mean, for example, Axis is something you'd highlighted. What's today?
Well, if we look at financials, it seems that they are actually reiterating their confidence on the business. So first, let's talk about RBL Bank. What management said to Citi is that they see substantial opportunities in accelerating the product vertical and at the same time also diversify the income sources. Apart from that, they also believe that the cost of fund is likely to come down, and there are two reasons for that. First is that the equity augmentation that we saw, and second is the potential post-merger improvement in the credit rating. When we look at the asset quality, they do not see any kind of worry in the MFI segment, but specifically in the card segment, they see that in the next 3 to 4 quarters is some period where they will still see some kind of stress, and the amount will come down below 500 crore mark after 3 to 4 quarters. Now, let's come to SBI, the biggest bank. Before coming to SBI, let me remind you what happened yesterday. Axis Bank actually pushed their target for the recovery in net interest margins, and after that we saw some negative sentimental impact. But what SBI is saying is that tailwinds from TD repricing and lower bulk deposit will be more than enough to neutralize the combined effect of 25 basis point of repo rate cut and MCLR repricing. So this is the biggest bank actually giving some confidence that the net interest margins may remain stable from here on as well. Apart from that, they are also confident on their growth guidance. They say that RAM is actually doing well. Corporate, they're expecting to grow in double digits in second half, and that is the reason why they believe that they will achieve the guided range of 12 to 14%. In fact, they will achieve the medium to higher end of what they had guided earlier. And they also see CASA, from CASA specifically CA, which is current account, is growing at around 13 to 14%. Now, from banks, let's move to NBFCs as well. L&T Finance is where Citi is with buy rating and a target price of 330. What management is saying is that they're confident about the disbursements and achieving the AUM growth of more than 20% in this year. They are also confident on achieving at least 2.8% RA by the end of Q4 FY27. Remember, the ROE is at around 2.4% in second quarter of FY26. And lastly, they are also confident on achieving almost 2% credit cost. When it comes to the utilization of the macro-prudential provisions, they do not see any need for utilizing this anymore. Right. That is also something which is positive for L&T Finance in the commentary.
Okay, all right, Gaurav, thank you very much for that. A couple of seconds ago before we open out, of course, we'll watch for SBI because Citi moved Axis Bank big time yesterday with its brokerage note. Let's see if SBI reacts positively. In terms of stocks, Meesho will be in continued focus. Yesterday, it hit record highs. And it's again up 3.5% in the pre-open. Then in terms of such stocks and news, watch out for Ahluwalia contracts, 4.5%. By the way, we've not spoken of city gas distribution companies. Should keep them on the radar as well, because that one nation, one gas transmission tariff that kicks off from now. And IGL is up 3%. There's a positive note from Nomura on IGL. And that stock's reacting very positively as well.
This company, Orkla, which is MTR, which we had them right here in our studios, which is recent listing. I think there's an initiation from one of the brokers, which is also there. I think stocks up some 2-3%. What do we have? First rates coming through. The Nifty is starting unchanged, almost unchanged, 25,870. The Nifty Bank is blinking red and green, 58,973. You've got the sensex, which is unchanged. Small cap index is up. Small mid cap index should be, something similar as well. So not very much to report right now. But small cap index is looking a lot better, about 0.25% higher. Let's just look at the Nifty 50 heat map, and then we'll quickly turn our attention to individual names, because I guess there's more action there, Vedanta and the like. Shriram Finance is on one end of the spectrum with a pop coming through, as we've been highlighting. Perhaps a deal brewing. ONGC is on the other end, and some insurance companies as well. HDFC Life, ICICI Bank. It's ICICI Bank actually. Grasim, Dr. Reddy. So it's kind of evenly split between what's up and what's down, and there's a grand total of 2 points to show for it, at least within the first 60 seconds of market open. Surabhi.
Absolutely. That big block trade on Akzo Nobel has just happened. Stocks down 14%. The anticipation was that 9% equity will move, but I think it's even bigger. 11.5% equity has moved down, 15% lower on Akzo Nobel. IOB, where the government is selling about between 2 to 3% of its equity, that's also in focus, down about 3%. So large block trades in focus. But on the large cap screen, it's really all about Shriram Finance as the market continues to buzz with excitement. Finally, is there going to be a deal announced or not? We'll have to wait and find out. 2%. SBI is the other one that is reacting quite positively to that Citi report. 968 is where SBI is at this moment. Eicher Motors, Hindalco, Bharti Airtel, these are the gainers. TCS is up about 0.5%, just under 0.5%. Eternal is recovering after yesterday's slam dunk. Let me just check what's happening with Swiggy, because Swiggy also sold off big time yesterday. It's very, very flat right now. All eyes, of course, are going to be on Zepto, which is coming out with another big issue in the near future, perhaps as early as next week. But that's it. It's pretty flat trends otherwise on the Nifty. On the downside, you have a couple of financials. ICICI Bank, HDFC Life, HDFC Bank. So some of these names on the lower end. Nigel?
The stock to track, Meesho. Just take a look at that stock. Massive volumes in the first few minutes. The stock is up 7.5%. For this week, it's up close to around 18%. Big move is what we're seeing on that one. That large trade has got out of the way, I think so, with regard to AkzoNobel. So that one's got cleared out. Explains why that stock is down. And silver is the one that continues to twinkle, shine, whichever way you want to put it. Because of that, we're seeing a lot of these ETFs that are up. And the only way to play it is Hindustan Zinc. And Vedanta, because of their holding in Hindustan Zinc, they get some bit of a tailwind as well. So explains why that stock as well is doing pretty well. On the flip side, you have Shakti Pumps that's coming for a bit of a breather. Polycap actually is down on pretty large volumes. 3.5% lower is, Polycap, that stock is a little bit lower. And IOB, because of the fresh supply that's likely to come in. So that's another stock. Bandhan Bank is a stock that I'll be tracking. For the last couple of trading sessions, I've been highlighting that's a possibility that it could come out of the F&O ban. And today it appears, that could be the day, just going by the details that we have. 81%, open interest as a percentage of MWPL. So Bandhan Bank is a stock I'll keep on your radar. Net, trading in the green. The street would like that after yesterday's final tick was at the low point of the day.
Just one more stock. Watch out for Ahluwalia Contracts. It's seeing a big move right now, almost 6%. Volumes are very thin. Need to keep that in mind. They've got a large order, almost 900 crore rupee order from the Bihar State Tourism Corporation. And that stock's up about 5 to 6% as well. By the way, L&T Finance, another NBFC which Citi highlighted, and they have a positive view in their latest brokerage note. That stock also up 1.5%.
20 points, right, so far, and that's the overall picture. The big casualty from yesterday was PV Fintech. Was down almost about 5.5-6% by close. That's stable. It's down 1% this morning, 1.25%. So just under 1,800 now on PV Fintech. So watch out for that as the day progresses as well. What else? Shakti Pumps has had a bit of a big move from 550 levels to 750 very quickly. So it's seeing some give back, 3.5% or lower. It's got large volumes. Akzo, Polycab, etc. we've mentioned. There is Reflex, which is up about down 2%, had a bit of a move last few sessions. Praj had a large move yesterday. Actually, last 2 days, Praj moved very, very substantially from about 290 odd levels to about 350. So a little bit of pullback. NetWeb is down about 1.25%. HBL is down about 2%. Indian Overseas is down about 2.75%. And so it goes. So that's basically the stuff on the downside, which is coming up with volumes as well. All these silver ETFs are, again, of course, up and about, right? Silver B's 3.5 higher, and there's HDFC Silver and all kinds of stuff, right? So these are all ETFs, all up between 3.5%, and of course on the equity side, Hindustan Zinc up another 2% at this stage. So that's something else which is coming through. Not very much else. I mean, Reliance Power I can spot with a 3% pop. There's HCC, bombed out name completely, 4% higher this morning. IGL we mentioned, Ahluwalia we mentioned, Tata Motors commercial vehicle business, that is up about 2% this morning. Eicher is up about 1.33%. So it's quiet. I mean, there's nothing dramatic happening with regards to some of the stuff. HPCL, oil marketing companies, because the oil fall, I mean, they're up about 1%, but there's also, of course, I mean, at the margin, there's risk that what Trump will do with Venezuela, will that cause a bit of a spike in oil prices? So we'll have to see. But of course, I mean, the fall in oil has been a pretty substantial. WTI under $55, as we've been pointing out at this point. Let's do one thing. Let's, as we wait for a perspective on markets, let's line up some of the views that we got from the top insurance, companies that we spoke with yesterday. This is, of course, the country's largest insurer, LIC. So let's line up those bites. Let's look at, SBI Life, another company we spoke with yesterday. And of course, Bajaj Allianz was the other one of the largest private sector insurers who we spoke to as well. And we should be able to play some of that stuff, some of those sound bites out for you in just a bit. I think we have it. So let's just listen and quick listen once again to the top insurance company voices. We'll come back with a market perspective.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at. But looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get, early investment, and not just do they gain, but even we gain at the same time.
When it comes to distribution network to be broadened, the IRDA already permits that. Almost about 8 such banking institutions they can tie up with. So this will be really maintained. So the other piece is the merger of the non-insurance with the insurance. There also, I believe, the regulation can come in where they can probably lay down that, if at all any such thing happens, what are the precautions which needs to be taken, and how they will ensure that the liabilities of the non-insurers should not really get into the insurance companies. There can be a firewalls which can be created to really address this concern also.
Well, that's a big story, isn't it? Insurance. And we have the top voices from across the industry on it yesterday. Mahesh Patil is Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, great to have you with us here. Good morning. Thanks very much for joining in. From the insurance space, now with this amendment passing, although it doesn't have the composite license, the open architecture is missing, but there is other stuff. You're part of course, a conglomerate which is insurance businesses as well. But from an investment point of view, in your portfolios that you oversee, Mahesh, what's the leaning towards in this space?
Yeah, so insurance sector is a sector which we have been positive now for last 1 year. I mean, last year we had a lot of regulatory headwinds in that sector, okay, which impacted the growth over there. And subsequently, we have seen some kind of a relaxation over there. And I think overall, again, the growth in the sector, which had kind of mellowed down, is again coming back. There is some impact because of the commissions and the regulation on that, which could have some impact on the margins. But more importantly, I think the GST cuts, what we had seen, that is also leading to overall cost coming down for the buyers. And that is especially, say, in the health insurance space. And that's the reason why we've seen good volume growth. So I think as long as the volume growth remains fairly strong, and which you've seen in these monthly numbers coming in, I think the slight impact on margins, okay, which could be there, that can easily be overcome. And this is a sector which we see a good long-term secular growth, which can compound at around, say, 13 to 15% in that range.
That's insurance. Got that point. Mahesh, great to have you with us on the show today. Let's talk quick commerce, food delivery and whatnot, because, that's where the game is being redefined every single day. Look at Meesho. And I know that you won't comment on individual stocks, but I'm not quite sure what's going on here. The company finally came in and offered shares at 111 rupees. Stocks now, getting very close to 200. So is this FOMO playing out? At the same time, we've seen a cool off on the likes of Eternal and Swiggy. Zepto is hitting the market with an large issue next week. So this is a very hot space. How should investors think about it? And, what do you like? What do you dislike? And how are you, what's your approach to the whole space?
Yeah, so all these new age companies which are coming up, again, are disrupting the existing business model. And each company has a particular moat or a competitive advantage, which they are trying to get in and capitalize on that to capture the market. So market has already been there, right? It's more about getting the market, getting more market share. And these are very high growth companies. So the way to look at these companies is not just the next 1 year, 2 years. You have to take a slightly longer term view, say at least the next 3 to 5 years view. And then look at how this compounding growth over that period would lead to cash flows and the discount and see where the valuations are really fit into one's matrix. But more importantly, I think it's important to look at companies which have already established a clear leadership in that particular segment. So that ensures that they have the scale and size, which will help them to really bring down the initial fixed cost much faster. And if the competitive intensity is fairly well established, right, then I think the road to profitability is much clearer. I think these are the factors which we look at in these names. And where the competitive intensity is increasing because of another play coming in, then we see some volatility coming in, and we've seen that in the quick commerce space.
All right. Hi, Mahesh. Good morning, and good to see you in. A quick question on, the rupee move. That's seemed to be making some part of the street a little uncomfortable. Today, there is some kind of appreciation that we're seeing out there. Is that concerning, or is it par for the course? Some would argue that the kind of, slip that we have seen, maybe in fact it's intentional in a particular manner, to help us out in terms of the deficit number. What's your view?
So if you look at in this calendar year, this year, I think rupee has been one of the worst performing currencies. But the more recent fall, if you see in the last 3 months or so, that is also in line with what we've seen in some of the other Asian currencies also, which have depreciated. Obviously, I think India is still yet to sign the trade deal, so that's impacting. But I think it looks like the way the government is taking the route is that let the rupee, because RBI, which initially was defending the rupee at around 88 rupees or so, has now kind of given away a bit. The intervention is much lower. And I think the rupee depreciation is a mechanism by way we are trying to really ensure that the competitiveness of our exporters, which have been kind of impaired because of the tariffs, to some extent it is taken care of. And overall improve the competitiveness vis-a-vis the other currencies. That's a more recent phenomenon in the last 3 months where we've seen other Asian currencies also depreciate. And overall, from a market standpoint, I think currency, once it depreciates and stabilizes at a particular point in time, we have seen that it is normally positive for earnings because if you look at the Nifty, for example, around 50% of the companies have a positive correlation to the rupee depreciation because either they are having, they are exporting, especially sectors like IT, metals, oil and gas sector, even auto exporters. So in a way, I think it will also have a calming impact on the market once it stabilizes because you could see this translating into some kind of an earnings uplift. And yeah, so I think as long as once the market gets a confidence that this is a level where it will find support, I think you will also see then money flow coming into the market. And rupee now is slightly undervalued on a RER basis. So if at all we see that the current account stabilizes, which is actually showing a good trend in this last month, I think the rupee should hold on over here.
Okay, all right. Got that. Actually, a big appreciation is what we are seeing, in today's trading session. I think we should just pull up an intraday chart of the rupee. There's a sharp pullback. I was chatting with Lata yesterday and I spoke to a few economists as well. The RBI stepped aside. That was one factor that was plaguing the rupee. Then you had FI selling as well that had continued. But the hope is getting into 2026, there'll be fresh allocations. And maybe, in fact, India gets its share. So that's what could help it. And in fact, it's a seasonally weak month. In December, you normally see that the rupee is a little bit weakish. While getting into quarter four, the deficit number looks better. You have exports that are pushed out, which gives you some kind of support. So for the time being, stability and some appreciation is what we're seeing on the Indian rupee. Mahesh, I was just looking at some of the portfolios out there, and it appears on a sector like metals, if I'm not mistaken, you're relatively underweight. You could correct me on that. But what's the view? Because it appears there's a bit of a melt-up taking place in that space. Valuations come secondary, momentum comes first.
So in metals, okay, we might be slight underweight, but actually our view has been turning positive on the metal space, and we had increased or reduced underweight over a period of time. And again, the reason for that has been that the sector has been a kind of a underperformer last year, and that's one of the reasons it's underowned also. And with dollar kind of a weakening, we've seen uptick across metals. We are more positive on the non-ferrous side, though, because there we see drivers which are not short-term, but also more structural, because demand for, say, aluminium and this thing is likely to be better coming in from electric vehicles and also in this aerospace space. And there the demand-supply gap, okay, would be favorable, which will support prices higher. So I think that's the view on the metals. We are not negative. We are turning mildly positive over there. But again, this is a sector which is to be watched in terms of what China does, because it's still the largest consumer and producer of metals. And at the margin, I think how the Chinese economy and the IIP numbers track will determine in terms of how sustainable some of these movements are.
Okay, all right, got that. Thank you very much, Mahesh. Good to have your perspective on the market. And we wish you a very, very, happy holiday season and a happy new year in case we don't talk up until the 1st again. Thank you for joining in.
Thank you.
All right, let's take a look at what's going on. So there's a bit of a momentum that seems to be picking up right now. 55 points up on the Nifty, not bad. The mid-cap market is very, very quiet, though, you'd have to say. Not too much going on over there. And financials are, at least at the index level, Bank Nifty, again, extremely flat. Well, let's move on then and put the spotlight on Patanjali Foods. That's the next company on our radar. Now, the stock is down about 11% in the last 1 year. It's down almost 20% from its peak. So what will 2026 have in store for Patanjali Food and perhaps for its shareholders as well? Mr. Sanjeev Asana, CEO at the company, is joining in. And there are 3 key points we want to focus on. Mr. Asana, thank you so much for joining in. So we just want to highlight some of the key talking points, so to speak. Obviously, we want to get an outlook on the new calendar year that's upon us, 2026. Some idea also on how the post-GST cut era is playing out for the FMCG and the consumer space. And we want to understand what your overall sense is for the second half of the year as well, how the numbers are shaping up. So, Mr. Asana, let me actually start right there. The post-GST era. In the earlier interaction, and I just want to place this on record for our viewers, you had told us that the GST cuts alone could deliver additional 300 to 400 basis points growth for you in FY26. Is that still playing out? Are you on track for that? How are things on ground post the cuts, and are you seeing any bump up in demand?
So, Surabhi, just 2 parts. One is that we've seen the pickup happening sooner, especially in the HPC category in the rural areas. And there the demand seems to be gaining some momentum. The urban areas have not responded as well as of now. But my estimation is that, the third quarter, which we are right now undergoing, and the fourth quarter should be definitely way better. My expectation is by sometime by end of this fiscal, that demand momentum that has picked up will tend to flatten. It will not perpetually be there, but the base will be set at least 300 to 400 basis points higher. So we pretty much stay, to the course of this growth in the HPC category. The foods have not responded as well, and likewise the urban areas also have not responded. My sense is that it'll happen with a lag. I think all the changes that have happened, and I think consumers to sort of start responding and, with the affordability getting better, we are expecting certainly that fourth quarter onward, the foods portion of that will also get an uptick.
So, say by the time we are ending this fiscal, end of March, what is your expectation on HPC volumes, and what would your estimates be for the overall foods volume? Or we can talk in sales as well, because, the pricing has come down. But the question is whether the volumes will actually make up for it. So give us some sense on both the businesses and where the numbers could look like, either volumes or overall sales.
So HPC, we will definitely witness anywhere between 12 to 15% annualized growth, that we are witnessing the momentum, compared to in November when we took over the business last year. Definitely we should gain 12 to 15% this year. And I'm pretty much expecting by end of this fiscal, we should definitely be up apple to apple comparison, close to 10 to 12%. And on the other side, on the food side, the growth we have always maintained between 8 and 10%. Urban has not responded as well. So I'm estimating that anywhere between 6 to 8% growth we'll definitely see, by the end of this fiscal. And which is pretty much, par for course in terms of what the targeted numbers were at the beginning of the year that we'd set for ourselves. And so we are pretty much there on that front.
Hi, Mr. Asthana. Good to see you. By when does the FMCG business become 50% of your revenue? I think that's the guidance, right?
So the guidance is that in 3 years' time, we are very much, convinced about it, targeting all our efforts are in that direction. And as we are seeing the growth, that in the veg oil segment, the growth is pretty just about 2.5 to 3% what we get. In the FMCG segment, the growth, if it continues at 12 to 15% on the HPC, 8 to 10 on the food side, then in 3 years' time we should be very close to that number, which we had stated, in our estimations of where the businesses are going to head.
Okay, all right. I want to focus on the edible oil part of the business then. Could you tell us how has pricing changed sequentially? Point number one. And point number two, what kind of volume growth are you working with for the second half of the year on edible oils?
So first half was quite flat, and where we had this, challenge of some demand contraction that we witnessed, even though there was a marginal volume growth, but the revenue, the price points were lower. So which basically, gave a pretty flat growth rate. The second half has been quite good, aided by two key pointers, some duty change, which the government implemented earlier this year. So that has supported the domestic refining. The branded sales have tended to pick up in the wedding season that we're witnessing right now. And overall, so my estimation is that we should grow about 3% this year on the veg oil side. And next year should be relatively better, because I think we've come out of a contracting demand scenario on the edible oil side. I think next year should be relatively stable at between 3 to 4% growth. We should be consistently be able to get that.
3 to 4% growth for FY27 and FY26, second half of the year 3%, or for the year you're talking about 3% after the first half?
I'm talking for the year. The pickup is quite good in the third quarter. Okay. And likewise, the estimation is for the fourth as well. So we should be
that's good.
For the full year.
So that's good.
3 and 4%. Yeah.
Got that. Just one more point, sir. In terms of market share, what is it? And in terms of edible oils, if you have to give me a margin, what is it likely to look like?
So margin, we are at about, till first half of the year, we were at about 3.53%. Which is very much what the company targets. And for the full year, we should be close to a similar number, maybe closer to 4%. That's what the estimation that we are having. And growth-wise, in terms of market share, we are quite close to 10% now. So edible oil is seeing, Nigel, sort of a consolidation in the marketplace, where the larger players are tending to benefit more on account of the consolidation, all the reforms that have happened, the risks on the FX side, including the, the working capital deployment that is required. So broadly, Patanjali Foods, along with a couple of larger players, are going to be a beneficiary with this market consolidation on the edible oil side.
Okay, interesting. So we're expecting stability over there on the edible oil business. Overall, on the FMCG business, Mr. Asthana, I believe palm oil prices have been going up quite a bit. Can you give us a sense on margins? Second half, how is it likely to be for your non-edible oil business? And if there is indeed a lot of raw material inflation you're facing?
So earlier this year, Surabhi, what had happened was that the palm oil prices had gone beyond soya and sun prices. which had quite a significant impact in demand contraction for the palm oil prices that supported quite a bit of soya and sun. Now, this dynamics between the three segments in the veg oil plays out quite a bit. I just wanted to take a minute to talk about our oil palm plantation business. So that has been a sort of a growth engine for the company. We had already crossed 110,000 hectares of plantation. This year, the estimation is on the P&L side, on EBITDA basis, we should be upwards of 300 crores plus of EBITDA that will generate on the oil palm plantation. And this I'm expecting every year will continue to grow at anywhere between 10 to 15%, both on the revenue side as well as on the income side. So which is a big driver of growth in terms of our dependence on the imports is diminishing to that extent. Marginal still, but my estimation is that progressively this is going to continue growing, gaining more momentum, and will become a pretty large part of our overall profit margin.
Yeah, so just quick 10 seconds left on this, because there's so many positive levers working for you. You have your own, palm oil production now. You're saying that business is shaping up, 300 crores of EBITDA. Plus the mix is going to change. There'll be more and more FMCG getting added. So what is the margin trajectory for Patanjali Foods at a blended level? FY25, your blended margins were somewhere just shy of 6%. What should we expect in FY26 and FY27? How does the profile change?
We should be 6%. And progressively 100 basis points each year we'll keep adding. And our stated objectives were 50,000 crores revenue, 5,000 crores of EBITDA in year 3 to year 4 from now.
Okay, and 100 basis points improvement in margin going forward on a steady state every single year. Got that. Thank you very much, Mr. Asthana. Good conversation as always. And let me take this opportunity of wishing you a very, very happy festive season and a happy new year as well. We'll take a quick break on that note. Up next, Prashant is chatting with the top team from Bank of America Global Research, talk about their outlook for 2026. Amish Shah, Gunjan Prithyani and Neha Manapuria joining in for that conversation.
Hello and welcome. As we look ahead into 2026, markets are navigating a complex transition from post-GST adjustments and earnings resets to shifting consumption patterns and a long-awaited cyclical recovery in markets in key sectors as well. 25 has arguably been a tough year. And of course, expectation as we turn the chapter over into the new one is that it's going to be a little easier. Easier, not easy. Well, adding to the complication, of course, more recently has been the slide we've seen in the currency, the rupee, that is, from 90 to 91 in about 10 sessions, being pushed back this morning as we speak, but we'll have to see. To help us cut through the noise, we are joined by the core of Bank of America Global Research's India Equity team, analysts who advise some of the largest money managers and institutions investing in our markets. Amish Shah heads equity strategy at BofA. Gunjan Prithyani tracks autos across, two-wheelers, passenger vehicles and tractors at BofA. And Neha Manpuria covers hospitals and pharmaceuticals at the firm. We'll try and break down what 2026 could look like for markets overall and, of course, for some of the key sectors as well. Thanks very much, all of you. Gunjan, Neha, Amish. Appreciate you guys coming down.
Pleasure.
So should we start right at the top? From a strategy point of view, Amish, how are things looking? The consensus is that it's going to be a little easier, as I said, not like an explosive move or anything of that sort, but maybe a little better into 26 over 25. Is that just turn of the year kind of optimism? We all feel a little more optimistic at that time. Is that time of the year, or you think it's grounded in numbers and you can sort of build that case up from bottom up?
I would agree. 26 is looking better than 25.
Yeah.
So let's say same time last year, markets were looking expensive. Earnings growth expectations from consensus was quite lofty. It seemed like earnings will come off. Small and mid caps was driving the rally. In fact, lower the float on the stock. Those stocks were doing well, which seemed like momentum trade that will not sustain. So I think all of that is now behind. If you look at so far in this calendar, for Nifty companies as well, FY26 consensus has already cut their earnings by 11 percentage points, and for FY27 by another 6 percentage points. So I think earnings expectations are now sensible, and earnings growth we think is going to accelerate. So as a result of that, valuations are now also looking reasonable. I would not say Indian markets are cheap still, but they are now reasonable. And with earnings improvement and no more earnings cuts, I would argue 26 is much better. And then finally, when you look at the events calendar, what can drive the volatility in the market, we do think that the events are also skewed on the upside rather than downside right now.
Lesser events which can derail the story in that sense, maybe, right? Hopefully. Has rupee come up in conversations with clients lately? In what way?
Well, it's in the front and the center right now because it's an unknown. And as we know, market always likes to have predictability. So, till the time, and we know the drivers of why the rupee is being weak. So how do you price in? At what price do you say that the rupee is now adequate? Will it appreciate? Will it continue to depreciate? So clearly there are sensitivities for stocks around that. So I think it's in the front and the center of the conversation. If you're a near-term investor, for the long-term investors, they do think that at some point in time, now we are at the fag end of this depreciation, things will settle down, and then they are looking at X of currency, how should they build their portfolios?
So for new investors, foreign investors who are coming in, I mean, you're better off buying now if the currency were to be stable from here, in that sense, right?
Definitely would say so. Even otherwise, for a foreign investor, I would say that, historically, whenever Fed has cut rates, it has led to EM flows. Whenever dollar has been weaker, it has led to EM flows. If you look at our own house views, we are expecting only 4% returns from S&P next year, but we are expecting 12 for Nifty this year, in CY26, right? So clearly returns also are skewed in favor of Nifty rather than the US. All of that basically points to the fact that logically, FII outflows should at least become zero next year, possibly could also be inflows.
So no more money out from equities, foreign money.
Is our view.
Is that view. And but is there any framework to kind of be able to sort of tell as you begin, or is it just like a function of various things, positioning and how much has been already sold, etc.?
So positioning, yes. But just think about it that if you are a multi-asset fund manager, then the way you are likely to look at is debt versus equities. So the 10-year bond yields are currently around, call it 4/4 on an average. So 4/4, add to that the risk of rupee depreciation. So you might be probably expecting, let's say 6/4 as rupee risk-free. And then add to that the fact that you're not buying bonds, you're buying equities, so you need risk premium. So let's say 5% for equity risk premium. So you're expecting about 11+% returns. As far as the markets give you a visibility that is possible, then the preference is more in favor of equities than debt. And then if you switch to, let's say, within equities, if I'm an emerging market portfolio manager, and then where do I allocate money versus India, China, Brazil, etc., then as I'm saying that on the back of the fact that India's earnings have come off, valuations are now looking okay, India at least is one of the alternatives versus throughout this calendar, India was a avoid. So I think all of that put together, whether you are an equity fund manager allocating between markets or whether you're an allocating across asset classes, FII outflows definitely, in our view, should stop.
We had a senior person from Bank of America on the currency side, on the fixed side, last week, and I asked him, towards the end of the conversation, I asked him, what's the one non-consensus view that you have? And he said, well, dollar will appreciate in 2026. Well, I don't know if that's a published view, but he said it on record. He said it. So, yeah, lots of moving parts. We don't know essentially what's going to happen, but it's a constructive framework, Amish, that you're working with, right? Let's get to some of the sectors now. And Gunjan, autos has been the savior sector in that sense, right? Has done very well, and some of the stocks more than others. What Amish was talking about, that earnings will pick up and perhaps consumption picks up, etc. Are you seeing that evidence after these cuts? What started after a bit of a pent up because there was that festive thing and the Shraddh period, and those cuts happened, and right out of that there was of course a big bump in sales. Has that sustained? Are you seeing that being durable, that bump in auto sales being durable, and in what segments mostly?
Sure. Certainly I think GST has been a very important catalyst. If I look at the sector growth, it's accelerated from nearly nothing in the first half to now in the range of 8 to 10%. So to your point, yes, there was a huge bump, almost 20% up during the festive days. But if you actually even normalize for the time the GST announcement was made till date, the registrations are up between 8 to 10% across various subsegments. So clearly there has been acceleration in growth and it's holding on. Our view is when you think from an auto upcycle perspective, everything that matters, be it credit, crude, cost of ownership through GST rate cut, cost of compliance, regulations are a lot lesser going into the next 2 years. A lot of things are aligned and hence, our view is that growth should sort of sustain going into next year as well. But I think the more pertinent point is, like you started off saying, that auto has been a savior. It's a space that's done well. The pertinent question that we face from investors is what's in the price. I think that's where a lot of positive revisions happened immediately post the GST rate cut. And now it seems like, the expectations have more or less aligned with this 8 to 10% sort of subsegment growth that we are seeing across the various
In some categories, are we going to very quickly revert back to the same kind of situation which persisted before the GST cuts, which is of too much inventory, etc.? I mean, are you starting to see any of that or no? It's kind of flowing through well.
So I think, of course, growth will normalize as the base catches up, but I think, 6 to 8% sort of growth looks par for course. It is
volume growth.
Volume growth, yes.
Oh,
so for PVs and two-wheelers, 6 to 8% sort of volume growth looks par for course as we get into a more normalized base next year. Of course, next couple of months, still the visibility of growth is higher, etc. I mean, you could see two-wheelers numbers being in double digit, but that's more of a base effect. So 6 to 8% for fiscal 27 seems par for course. I think the interesting subsegment could be CVs, which has had no implication from GST as such, but it is a second-order beneficiary of any economic recovery. So that's the segment probably to watch out from a next year's perspective, where expectations are still relatively reasonable, and we are starting to see a little bit inflection on that space.
This entire rare earth magnet issue, right? I mean, it's kind of disappeared off the thing. Although there's been companies are doing just fine without. So how's it happening? I mean, or it's going to be, it's an issue to watch in 26 as well, or you think it's sorted now?
I think at least it's sorted in the short term. But there are two things playing out here. One is the easing of the supply chain. There's clearly a lot more availability now than it was a few months back. Secondly, if you also look at the EV growth in itself, that's sort of moderated. And that's outcome of, GST, because GST has made petrol vehicles cheaper, and hence that, this whole argument of shift towards EVs has been pushed out for a couple of years. I mean, we are seeing a lot modest growth in the on the EV side. So it's both combination of supply and demand being a bit modest, but I think longer term we'll need to find a solution, which is where, lighter rare earth materials, some of these companies are working towards that. Those are solutions we'll have to watch out. But for now, 3 to 6 months, I don't think that's a big worry in minds of corporates.
Niyam, let's talk about, you track hospitals, you track pharma, right? So let me actually pick up with pharma, which is, of course, a big export sector. And the obvious question is this rupee thing, right? Does it make a difference at the margin for earnings?
Not really, not as much as probably it does for the other sectors. While pharma is export-oriented, I think the one thing different about pharma is, it's not, US is the largest, but it's not the only market. You also have Europe, you also have, emerging market where currency tends to be volatile. And then you also have your raw material cost, which is usually USD pegged, and some amount of your spending is also pegged to local currency. So the flow through isn't as much, and therefore you don't see pharma stocks react as much to FX moves. I would say less so for pharma.
So what's the big dominant driver going to be for pharma, to your mind? Or is it going to be different things and different kind of subsegments where you'll find places to make money?
Yeah, so I think while we use the term pharma, there are like 3 different subsegments. For the large cap or the US generic focused names, I think the tariff news has sort of died down. Yeah. Is the possibility completely out? No, you never know, right?
Which is those sectoral tariffs.
The Section 232 tariffs, right? At the moment, what White House has said is there's unlikely that generics would be included in those tariff discussions. Even for branded, we've not really seen anything come out other than the one tweet. So I think the tariff noise has sort of died down. It does not come up in conversation as much. I think for the US-focused names, the big debate is as you get into 2026, you had this very large product limit for most companies, which is going away, right? So how do you fill that hole? So are you looking at how is your US pipeline looking? Are you looking at other growth drivers? We have seen companies use the cash flow from, this large drug to diversify their business and enter into newer segments, OTC, medtech, specialty. So I think there's a lot of focus on which of these will be your sustainable growth drivers and, drive earnings momentum, probably not next year, but 2 years out. And therefore, valuations are, I would say below, long-term mean, because there's still a little bit, headline earnings won't look as great because of Revlimid going away, but a lot of focus is on what happens to that, capital allocation that you're making into these newer areas for pharma companies. And I think for CDMOs, obviously, there's a lot of discussion around, reshoring, Biosecure Act, with China in licensing, how that impacts biotech funding, winters, has that improved? So I think there is more action, I would say, happening on the news flow side on CDMO versus the US pharma.
The exporters into the
yes,
US. So,
that's right.
And that's an area of interest for you in terms of CDMO, perhaps over the large cap
yes,
companies.
Yes.
Okay, hospitals we've not gotten to yet. I have to take a quick commercial break, so allow me to do that. I'll just take that, come back, and we'll continue this conversation right here. So let's do that. Take a break, and the BofA Top Equity India team is with me. We'll, of course, dive down into individual some of the ideas and what they like more than others. So all of that coming up in just a bit.
Welcome back. The market's flattened out again. So the bulls have not been able to have a decisive grip over, what we've seen so far. So that 50-point up move, it's also getting sold into pretty volatile and choppy. And it's extremely flat across the indices. I mean, the mid-cap index, the bank nifty, whichever way you look at it, there's no clear headway as far as the day's action is concerned. And even Shriram Finance, which at one point in time was up 3%, lots of excitement ahead of their board meeting, that stock's fizzled out a bit as well. It's up about 1.3%. Now let's see what's happening in the world of commodities. We've got Manisha joining in with the latest. Manisha, what do you have your eye on?
Well, I have it on precious metals and crude for sure, and I'll take you through all of that. The gainers first, and the precious metal prices have continued to surge. This is on the back of U.S. non-employment rate, which has risen to almost 4.6%. You also have the dollar index, which continues to decline. That one is trading at around 2-month lows right now. And the U.S. benchmark 10-year Treasury yields also have edged lower, absolutely supporting the precious metal price gains therein. A lot of money continues to come into the tangible commodities. So whether it's metals, precious metals especially, is where you have allocation coming in on. I want to start with silver because we have seen yet another 3.5% of gains in the overnight market. And with that, it's an all-time high of $65.65 an ounce coming in for the international markets there. With that kind of a gain, we are up by 30% in last 1 month. And for the year 2025, silver is an outperformer, best performance really coming in from this one with the gain of 127%. Silver has hit a record highs, not just in the US markets, but in India, Europe, and various other countries as well. It has been about potential silver supply deficit for a 6th straight year in 2026. And then you also have a lot of backing coming in from speculative money. You have investment demand, not just in India, but various other parts of the world also supporting silver prices there. Gold is trading very close to all-time highs. It's trading above $4,300 an ounce. You have platinum, which gained up by 4% overnight. It is trading at 2011 highs right now. And you have palladium as well, gaining 2.5%. That one is trading at 2-month highs. But that's exactly where the gains end. Because take a look at the energy markets, and we've seen constant declines onto this one. Whether it has been about crude, natural gas, heating oil, gasoline, all of these commodities have continued to decline. Crude oil prices fell 3% overnight, trading at a 2021 low. So it's a 5-year low now for the crude prices, where WTI and Brent both have declined quite sharply, posting out 23% of a decline for this year. And this is a 3rd straight year of decline coming in for the crude oil prices there. So when you look at the WTI, it's headed for a worse performance since 2018. And the Brent also is seeing a worse performance since 2020. Well, in the Asian markets right now, there's a bit of a buying. And this comes in after the U.S. president says that there is a complete blockade now on the sanctioned oil tankers linked to Venezuela. That led to some sentiment gaining into the markets. But apart from that, there's nothing really that is supportive for the crude oil prices. You have progress towards Russia-Ukraine peace talks. That would mean more Russian oil finally coming into the markets. And there is Russian oil stored on water, estimated at around 170 million barrels. So if that starts coming into the global markets, you're looking at prices declining from here. Adding to that is the OPEC Plus steadily restoring its shut-in capacity. Not just OPEC Plus, you have non-OPEC producers also ramping up in sense of output. And in front of that, you have signs of weak demand from China, western part of Asia and US as well. But what the markets are also looking at going forward is that there's a 75% probability of Fed holding rates in the month of Jan. Having said that, this week is quite active. You have monetary policy meetings coming in from Bank of Japan, Bank of England, European central banks as well. Next week onwards, of course, the volume thins and you have a holiday season starting. But before that, this week promises to be very, very volatile.
Okay, all right, got it. Manisha, thank you very much for that. So we'll keep an eye out on both crude as well as those precious metals. But for the time being, let's look at Meesho. I mean, the stock has had this phenomenal run. It started its journey even this morning, substantially higher. And the gains since listing day are breathtaking, to say the least. 111 was the issue price, and it's knocking at the doors of 200. There is a positive brokerage call coming through on Meesho today. Let's get to Manglam for more. Manglam, wow, what does one say?
What a good story it has been so far from a consumer standpoint, yes, from an investor standpoint as well, ever since it's listed near 80% high from its issue price, and this at a time when the company operates an asset-light negative working capital business model, which implies that they have free cash flow. The management during the IPO as well had been guiding to us that don't go by the reported EBITDA numbers or the reported net loss numbers. On a free cash flow basis, the company has over 1,000 crores. And that is something that they are looking to continue and grow going forward as well. UBS has, taken note of that. They've initiated coverage on the stock with a positive view. They have a target price of 220, so just about 10% away from where it is right now after a near 80% rise that we've seen from its issue price. They're saying that the net merchandise value is expected to compound upwards of 30% over the next few years. And contribution margin, this is another thing that the company had said. Global benchmarks are close to 8 to 10%. They are currently at around 3.8, 3.9%. UBS expects it to be around 6.8% by FY30. And the average order value of the company has been declining because of efficiencies in logistics. So that's something, again, from the red herring prospectus coming down from 274 to 233. And importantly, the order frequency because of that has increased from 9 to 15. They believe that it will continue to increase as average order value comes down. And the average transacting users as well. Currently about 20 crores, which is 1 in 6 Indians, 1 in 7 Indians. They expect this all the way up to 51 crore in the next 5 years. So put all of these ahead with the growth tailwinds ahead. They value the stock at 220 rupees and the stock's racing towards that.
Yeah. What's also racing is Vidit Atre's own valuation, the Meesho founder. With this kind of a stock surge, now he's entered the billionaire club. Just within a couple of days of listing. Thank you for that, Manglam. Indeed, what a fascinating story that Meesho has turned out to be. We have to take a break right now, but on the other side, we have our special segment, It's the Economy, coming up. Lata today will be speaking with Jahangir Aziz of JP Morgan about the US jobs data, the Federal Reserve, and the outlook on the rupee.